we can begin, I guess, discussing our first model. So what I'll do is I'll have a post that I did on Sunday, which is a sort of a culmination of all the work that Sminston and Plancy and I have been doing on the Quantile model. And this is going to be unique because it gives us a specific playbook and strategy for the next year. Then we will switch to Sminston and Plan C. They each have one chart to present as well. And we'll take it from there. So without further ado, and because we want to really cap this one at 1 hour, I'll begin discussing my content. So let me share my screen.
I do want to point out while you're pulling that up, Sina, if you guys don't mind, I don't think it's a coincidence that since we started the Best Bitcoin Data Show, this is episode 5, we scratched 69,000 the other day, and today we dipped down just a little bit. But I don't think it's unreasonable to give ourselves a little bit of credit here. So I think we need to continue to grow the show and keep pushing that price up. So
absolutely, yep. Yeah, I'm sure the billionaires are watching our show and making purchase decisions. By the way, Bitcoin is just moving according to the model that we have, right? So it's, even though it has gone so much up, it's still hovering around the fair value that we've been able to calculate lately. And we introduced that fair value discussion, I think, a few weeks back, where the price was substantially below it. Now it has caught up. And if it follows the past trend and the assumptions in our models are correct, we are going much, much, much higher. So we still haven't even seen the main action yet. But with that, I will switch to this chart. Let's see what's the best way. Yeah, okay, so we are around that. Okay, this is a post I made on Sunday. It took me several hours work up until 3 a.m., but it was so exciting that I just couldn't sleep. What I was doing is I was creating a quantile model of Bitcoin, which again, Plan C, for example, has done amazing work on this, and we've been discussing this a lot on the show lately. But I was analyzing the specific quantiles to see if I can identify a pattern that explains Bitcoin's transition through different phases. Now, what I discovered, I tried several things, but what I discovered is that there seem to be 3 important quantiles that make a big difference in Bitcoin. So let me just show you something, and then I'll probably go back and explain the whole thing from scratch. But if you look at 33rd percentile and 66th percentile, and look at the chart here, you'll see that actually a lot of you can detect phase transitions between these percentiles. Below 33 seems to be the bear market bottoms typically, and black swan events, capturing a lot of the boring price action that has been happening in the prior cycle. Between 33 and 66, we have these kind of warm-up period where Bitcoin is getting ready for a significant explosion in the bull run, or maybe transitioning from the end of the bull run into the bear market. And then typically the top of the main price action of bull runs start after quantile 66. So it seems like, and even like if you notice, the top of the ETF bull run, ETF run coincided with 66 percentile. In the first crash in 2021 got us back down to 66 line, and a few times we had important reactions when we reached the 66 line. Again, another crash in the second cycle got us back to here. In the end of the first cycle, we also had reaction around that line. And same thing in the bear market time, there's a lot of reaction around the quantile 33. So it seems like these are important points for Bitcoin's phases. So based on that analysis, let's go back. So first of all, if you're wondering what is a quantile model, it's basically a regression model that uses the power law power law equation that models log of price as a function of logarithm of time, and time starts from the genesis block. And what we do is typically the traditional way to do this has been to run an OLS regression that models the average price, like a point that goes through the average of all the Bitcoin data over time. But here, the problem with that is not really a problem, but it only gives us the average, but it doesn't really inform us about the volatility around that average or the distribution of values around it. So there are many ways you can model this distribution. Perhaps you can run a much more advanced structural model that extracts distribution, maybe a Bayesian analysis or something like that. But a really nice way to strike a balance between simplicity and richness is to run a quantile model. A quantile model not only gives you it doesn't give you the average, but it gives you all the possible quantiles that you like. So it gives you the end of the distribution on both sides, the extremes, and then the median and anything else in between. So that way you can model the spread as well. So if Bitcoin is getting less volatile over time, this model will be able to capture that and give you nice bounds that match data a lot better than, say, for example, just getting an average and moving it up or down by some amount to get a bound. That kind of bound, in other words, the OLS model assumes that the volatility is the same over time, right? But quantile model does not. So it gives us a much more realistic view of the range of values. Now, if you run a quantile model, again, you get curves that match quantile. So, for example, the Q1% that I've coded here, this is first quantile. This is a line that's designed such that only 1% of the data is below that, and 99% of the data points are above that, right? So that will coincide, if you extrapolate it to 2026, that will coincide 55,000. So it's only 1% chance that we will be below 55,000, right? And this is amazing because this gives us probabilities. Like it's not very sensible to determine and select a single value and say, okay, my price target is X, right? That's a lot better and smarter approach is to think in terms of probabilities. Everything is probable, but some values are more or less probable, right? So this model gives us something like that. Below 55,000, only 1% likely for the end of 2026. And then we can choose many other quantiles. And like I said, I thought maybe I can break the whole probability into three categories, three classes or bands. The next important quantile is 33rd, and that's $85,000, meaning there's 1/3 chance that we will be below 85K by the end of next year, and 2/3 chance that we will be higher than that. And then, this is kind of understating the potential because you don't see how these quantiles, like 66 quantile is way higher than 33 compared to the difference between 33 and 1. So to make that more clear, I can go to the second chart, and this is now a linear chart that shows us a little bit better, like the acceleration as we go up. So quantile 33 coincides with 85 at 2026, but the end of that band is quantile 66 with 136,000. So what this tells me is if the distribution of probabilities follows our model, if that's correct, then you get a 2/3 chance that we will be below this number by the end of 2026, but 1/3 chance that we will be above that. How high it can go? It can go up to 285,000 when we look at 99th quantile. And this orange curve is designed again such that 99% of the Bitcoin data falls below it. So there's only 1% chance that it will be higher than this by the end of 2026. And we are not necessarily timing, right? We don't know when the actual peak will happen. It's very difficult to predict them. And if you even have a quantitative model for that, you're only basing it off of the last 4 cycles. So it can't be anything much stronger than a guess, right? We really don't have much cycle data to have a very reliable estimate of that. So at least in this analysis, I'm not trying to time the market. I'm simply saying, where are the valuation places? So Bitcoin can go to the top, by after the election, which is very unlikely, but it can top sometime in 2025, early or late. We don't know. But these regions allow us to figure out how far are we from the top, right? Or how overvalued or undervalued we are. And that was the basis for writing this analysis. That gives us a kind of a playbook, right? So during the next year, and towards the end of the 2025, you're looking at these three bands as your guides. If you're anything below 85,000, we are in the first band, which I call the cold zone. This means the market is extremely cold and Bitcoin is very, very undervalued. So what you should do, not financial advice, but what the model says is you got to do aggressively accumulate. Bitcoin is very, very underpriced, and we're out of that range for now, right? We were actually in the blue zone for a long time. I was accumulating like all this process, and actually somewhere right after the end of the big crash, I was accumulating. In the blue I was, but I wish I did more. I still do, but not extremely aggressive now. So after we got out of the blue zone, we got into the green zone, which is, I call it, warm. The market is warming up, and you can actually feel that, right? The market, we are definitely out of the bear market depression and sadness, right? But we are now warming up. It really feels like we are kind of consolidating, and we're getting ready for an explosion. And actually, very recently, if you look at this downtrending channel, we seem to be wanting to get out of it with the recent price action. So the market is warming up, but it's far from even showing us the real potential of the bull market. Now, what do you do in that region? You continue to accumulate. That's at least my strategy. And I love to do dollar cost averaging. I call it DCA in, meaning you add using a DCA strategy every periodically add something. The simplest way to do that is to purchase equal amounts, and that has some nice properties that allows you to avoid worrying about all the volatility. Dollar cost averaging cancels out all the ups and downs and gives you exposure to the average growth, which is the fundamental valuation of Bitcoin. But if you want to use the maximum potential of this model, you can adjust your dollar cost averaging according to the risk. So you can also think of this as risk probability, as kind of a risk metric, right? If you're in the blue zone, the risk of going even further down is very low. So you got to be maximizing your dollar cost averaging if you follow that strategy. In the green zone, you get a little bit of more risk, but still the upside is much bigger. As we get into the red zone, and as these quantiles add up, the price goes up towards higher quantiles, risk builds up. So then the risk reward changes. It might still go significantly higher, but now the risk of crash also builds up. So you will adjust your DCA downward a little bit. And that's why I say in the hot zone, above 66 quantile, which will coincide 136 in the next year, $136,000 in the next year, you can do several things. First of all, if you are a permanent hodler, you can just continue what you're doing. If you're dollar cost averaging, continue that. Enjoy the ride. You will probably experience a significant crash, but you are diamond hand, so you don't care, right? Now, if you want to just add some more spice, like I said, you can make your DCA smarter and think about exiting, depending on whatever percent you're thinking about it, taking off the market progressively according to the risk. So let's say at quantile 66, 136, you still think this is too early. So maybe you wait until we reach 200,000. And then from there, you slowly trim your position. And the higher we go, you trim more aggressively. Because if we reach 285, according to this model, the upside is very limited. The downside is significant. So if you need money, if you need to buy something nice, that's the time to do that. But at the same time, it's never hurts to be a permanent hodler, and that works. That has worked perfectly in the past, and there's a lot of risk in trying to time these dynamics. But I think the smartest way to do that, if you want to, is to think in terms of probabilities and use a risk informed dollar cost averaging method. Sorry for the long rant, but that's what I had.
No, that was great, Sina. I was well explained, and the thing is, like, yeah, I really like this, and I like the way you've divided up into three sections here, because I think it really, yeah, it simplifies things, but it makes a lot of sense, right? That lower third is like you said, that accumulation period, and then you're moving up. It's interesting how we you already kind of showed it on the last chart, but we basically got rejected right at the 66 line there. Yeah, I mean, it just kind of was way too much too early. Like we were not ready. We had to consolidate for quite a while before moving up. But I guess one of my talking points we can discuss is this model, just so people understand the way you've done this here is you're not you're not factoring in timing, right? So you're basically saying you're giving an even probability that we can peak at any point within the 4 years, and an even probability that we can be at the bottom at any point of the 4 years. So this is basically timing agnostic. So if we do kind of take like if we factor in, say, the liquidity cycle, and we can do this with other models as we develop these other models that maybe can help with some of the timing. Most people would say, okay, this is the range, and we could technically be anywhere within that range. But based on historic patterns, we can say that we can assess potentially a higher probability that we're in the top third, second half of next year, maybe even into 2026. We don't know that for sure, but based on historic patterns, we can say we think there's a higher probability we will be in that upper range. So it's probably less likely that we're in the bottom two bands there, but we don't know for sure. So once we have liquidity models and other timing based models, we can kind of dial it in more. But this just gives an overview. It's like it's saying, okay, this is the range. That's really the main thing here, and I really like that. And like you said, we can be anywhere in that range. We think we're going to be in the top of it, but we don't know for sure. That's really the summary for me.
Exactly, and this is, as you said, timing agnostic. So we are essentially we are admitting that predicting the exact point of top is very difficult. And like I said, even if you want to do it, you don't have a real strong statistical basis. You can come up with something, but going to be very difficult. Instead, what we will do is we will create valuation models that will inform us about the probability of being at the top, or probability of being overvalued when we get there. So at least when we get closer to the top, we'll have a way to assign a probability to it.
Sorry, one very last thing. So because just so people understand, so you're saying there's a 1% chance we'll be above 285K at the end of next year. There's a 1% chance, but that's only on that single day. like it's a 1% chance basically of being there like every day throughout the 4 years. So at some point you're going to reach it, right? Or at some point there's a decent probability of reaching it, but it's not like there's a 1% chance of reaching it throughout the 4 years. There's just a 1% chance of reaching it on any given day.
Exactly. So it's more like Bitcoin will spend only 1% of its time above that value. But actually, if we follow the prior cycles, if we follow the prior pattern, we will get there, right?
We reached it the last 3 cycles. It doesn't mean this cycle will get there, but we have reached the last 3 cycles. So the probability is not 1% we reach it this cycle. It's, because people say, well, how can it be 1% if we reached it the last 3 cycles? But it's because you're looking at a 4-year window of time. So the probability is higher.
Yeah, it will be 1 day or 1 hour or 1 minute above that point, right? That's why the probability is low. But if you're worried about will we ever reach there, the model, again, with the big assumption that we will follow prior cycle patterns and we won't see a significant change in how Bitcoin works, then yes, we will get there. Now, a quick point on that: will Bitcoin significantly change behaving from there? Well, these models are cross-validated using a long period of time. There's a lot of out of sample data for a power law type growth. So we still haven't seen any significant deviation from this general trend, even with the major things that have happened to Bitcoin, including advent of the ETFs, or like crash after COVID. None of these really got us out of the bands that these models would predict. So if something really bigger than that happens, maybe, but we still don't have any evidence that Bitcoin will suddenly change trajectory moving forward.
Yeah, Sina. So a couple. So first of all, bang up job on these charts. I think you and Plan C both have this incredible talent for taking these very data-driven approaches and then putting together something that's very practically, very practical for the average person. And so a huge kudos to you for making this, and just the subtleties. I'm a sucker for the subtleties of beautiful visualization. Just the brightening of the area under the curve of the price data and things I'm just noticing now. So very attractive. What I love, a couple of things that I'm noticing. First of all, is just for the audience, as you go up in Quantile, each of those bands expand, right? I mean, you're breaking down each of these into thirds, but that upper band is the biggest band in terms of dollar range, right? So that's about 160K worth of a range. So as soon as you start to get into that band, the jump to the next quantile becomes larger and larger and larger, which is interesting. And so I guess what I'm getting at there is my mind is very visual, and I look at this in slices. I look at them in cross sections. And so the one that you projected out to 2026, I like to think of this in my mind as like plotting this out itself as a probability distribution. If you were to take that cross section, right? So that vertical line from 99th quantile down to the first quantile, the way I think about this is, you have, what am I trying to say here? If you plot this in 2D as a plotted probability distribution, you can see how, or maybe even a cumulative probability distribution, right? Because we're talking about probabilities here.
Mm-hmm.
You can see as you're going up the curve, if you imagine like the CDF, the higher and higher you go, further you go to the right, then smaller and smaller that slope is as you go to the right. So that shows you, basically your highest potential for returns are up, but no further than the top of that green band. So I really like this. This has a lot of potential to guide people as we move through the next year or two. And it's purely driven by what's happened historically. So this is all deterministic probability, correct, Sina? So this is, this opens up the door to so many possibilities of potential price prediction. Again, I like the timing of the cycle agnosticism. I'm of the same mind with that, although, there's probably a lot of literature, a lot of studies to show that there's some timing that's correlation to liquidity cycles and elections and these different preconditions. But I think at the end of the day, I think we're similarly minded where Bitcoin can do unexpected things from cycle to cycle. So this gives a good overall view probabilistically, and I really love it. So nice work.
And we want to be really honest from the analysis. Like I last cycle I was talking to a lot of people that were like, I look at what Plan B thinks and I plan my life around that price happening. But I always try to kind of warn people about these things and try to teach them that you have to have a probabilistic mindset. Everything is possible. But you can just say that some values are less likely, some values are more likely, right? But everything is possible. You shouldn't, plan in such a way that certain actions will wipe you out, right? So you got to be very careful understanding and interpreting models like this. So it gives you a guide, but you need to be prepared for everything.
Yeah, exactly.
One more thing. I'm just sorry to harp on this, but I love, again, imagining that 2026 slice. If you extrapolate those probabilities, if you extrapolate all the way to the 99.9th, 99.99 99.999, and you keep doing that right on a probability curve, you can kind of like look at the intersection of what the price would be versus the 99 point, it basically 10 to the -5th or -6th, -7th likelihood that the price will be there, and you will see a very, very high price, but your chances of hitting those numbers are going to be so minuscule, right? When you start getting into the 500,000, 600,000. I think it's really interesting.
Yeah, exactly. I mean, there's a probability of getting to $1 million, but that probability is so small that it's not even worth discussing, right? Like there is a theoretical probability that Bitcoin gets to $1 million this cycle, but is it the most probable outcome? It's not. It's it's extremely, extremely low. So, yeah, we got to look at what's the highest chance of occurring, I guess the one last thing I was going to say is we can also, like, there are ways to kind of assess the potential of how far we think we can move up in these quantiles throughout the cycle. Like we can assess liquidity compared to previous cycles and kind of get a relative, okay, how much liquidity do we have relative to previous cycles compared to how high we got. We can look at the flows through various ways. We can look at the flows of money coming into and derivatives. We can assess a lot of things to kind of get a kind of a potential of how far we think we'll go. It's not just going to be, kind of a random guess. We'll try to do our best to look at as many other metrics as possible to assess like kind of the potential and the fuel we have to kind of go higher up on this quantile band. But this is a great starting point.
Yeah, and a few people were asking about the super highly dangerous zones, and that's where I added the 90th quantile, 211,000. This is where you see like the top of the peaks will happen. I would be like, my personal thinking here is whenever we get to this band, this newly colored red band, above 90th percentile, I would be ready for a massive crash at any point. I mean, you might go up. As you can see, there is a whole lot of range here, $1,000 of range, but the risk reward has now changed at that point. So I would really call this one 90th percentile really the danger zone. And as you can see, we can go all the way up. And as you said, who knows? Maybe we go all the way up to 1 million. But at that point, we are going to be so overvalued and so volatile that, first of all, that may only last for 1 second. And if you think you can get out at the $1 million point, you're seriously overestimating your power in the market. So in some ways, I don't even worry about the top because I'm not going to be able to exit at the top, right? Just have to be honest with ourselves. And it's much better to think in terms of risk. So if you need some money and if you want to take some profits, you got to do it slowly, step by step, based on an understanding of the risk reward. So in some ways, I'm actually a lot more interested in the bottom growing than the top, because top isn't for me, right? I'm not gonna try too much, play with that.
I'm with you there, and I think I think fundamentally, going back to the fundamentals of the power law, right? I always come back. The closer you get to the tops, the more speculative you become, right? We just need a lot more data. This is probably the best way to aggregate that data to make some kind of a band projection. But I agree. I think monitoring this continued growth and seeing it stabilize and improve, as a function of Bitcoin's network growth and adoption, is really interesting to me. So I always come back to that, and I want to keep a close eye on that, especially as we go into these brave new times.
Absolutely. Yeah. A lot of interesting things are cooking under the surface. I love boring periods in the market because that's not stopping the development. That's not stopping the adoption. It's only keeping price from appreciating, because that gives us more time to accumulate. But then at any point, I'm just excited about all the beautiful things we will learn about in the next phases of the market. So be sure that big people are accumulating. ETFs were just killing it this last week. They've been accumulating a lot. There's a lot of discussions under the surface. The institutions are piling in. MicroStrategy style is multiplying right now. And everything is as bullish as it can be.
There's a lot of big headlines, like you're seeing every day on X. You're seeing different headlines about so and so companies, bought 100 million Bitcoin or whatever. Like there's a lot of big accumulation going on, right? Still, so interesting thing though, just so people can kind of keep this in mind, it wouldn't be abnormal for us to actually go sideways until next year. Like it's actually happened in previous cycles. If you go back and look at the patterns in previous cycles, we actually didn't really get above the 50th quantile, like the fair value, like we looked at previous weeks. We actually didn't really get above that in 2 out of the last 3 cycles until next year, technically. So in 2017, that cycle, we actually, I believe, we didn't break the 50th quantile until early 2017, and same with 2013. So it wouldn't be out of the question, or wouldn't be like abnormal for us to actually just kind of hang out and go sideways until even like February. I mean, it's not out of the realm of possibility. Now, I don't necessarily think that's going to happen, but it's not, it's a scenario to consider. I mean, we've already been going sideways for 8 months, so I think it's a low chance, but it's possible.
Exactly.
Yeah, I mean, there was a 4-year winter, right, between 13 and late 17. So
yeah, well, I mean, it's just like, as far as the bull run starting, like people forget how fast, like the full bull run, I mean, like the parabolic part of the bull run. So in 2013 and 2017, we actually, like those cycles, if you go back and look at them, things got overheated very, very quickly. So it would be the equivalent of us kind of going sideways until February or March of next year, and then shooting up and peaking at the end of the year, like really quickly, right? So that's kind of, that's what's happened in the past. But we'll see. I mean, last cycle we started to kind of rally more this time of the year, right? Like if we look at what happened in 2021, it was actually around here that we started to kind of really move. So we'll see.